waking up one morning to find that your local bank is no longer in business. It's a terrifying thought, right? But what if I told you that hundreds of banks across the US are on the brink of collapse? In today's video, we'll look into the shocking reasons behind why so many American banks could be heading underwater. From the ripple effects of economic downturns to risky lending practices, we're breaking down the factors that could lead to a financial disaster. The current stress on these banks comes from two major sources: commercial real estate loans and rising interest rates. According to Christopher Wolf, managing director and head of North American banks at Fitch Ratings, the situation could lead to some banks to fall short of their minimum capital requirements and, in the worst cases, potentially face failure. A study by the consulting firm Claros Group, which analyzed around 4,000 US banks, found that 282 banks are particularly vulnerable. These banks are grappling with the deal threats posed by their exposure to commercial real estate and the potential losses tied to the current environment of rising interest rates. Most of the banks under stress are smaller lenders, each with less than $10 billion in assets. While these banks may not be on the brink of insolvency, they're certainly under significant strain. As Brian Graham, co-founder and partner at Claros Group, explains, these banks aren't necessarily on the verge of collapse, but the stress they're experiencing could still have serious consequences for the communities and customers they serve. What does this mean for communities? Small and regional banks play a crucial role in the local economies where they operate. They provide loans to small businesses, support local real estate markets, and offer personalized banking services that larger institutions often cannot. When these banks are under stress, it can have a ripple effect on the communities they serve. For example, if a small bank becomes cautious due to financial pressure, it might tighten its lending standards. This could make it harder for local businesses to get the loans they need to expand or even keep their doors open. It could also impact individuals looking to buy homes or refinance existing mortgages. The result is a potential slowdown in local economic activity, which can be particularly harmful in smaller communities where such banks are often the primary financial institutions. The current environment of rising interest rates is particularly challenging for banks. On one hand, higher rates can benefit banks by allowing them to charge more for loans. However, they also increase the cost of borrowing and can lead to a decrease in the value of fixed-rate loans and securities that banks already hold. This is especially problematic for banks with significant exposure to commercial real estate, where rising rates can lead to lower property values and increased default risk on loans. For smaller banks, which may not have the same resources as larger institutions to absorb these losses, the impact can be more pronounced. As these banks face pressure from both their loan portfolios and the broader economic environment, they may find it increasingly difficult to maintain their financial health. What's next for these banks? While the situation is serious, it's important to note that not all of these banks are on the brink of failure. Many are simply feeling the pressure of the current economic conditions. However, this stress could lead to some banks falling below their minimum capital requirements, which could in turn force them to take actions such as raising capital, selling assets, or even merging with larger institutions. In some cases, banks may be forced to close branches or reduce services, which could further impact the communities they serve. For customers, this might mean longer wait times for loans, reduced access to credit, and fewer banking options. Although the number of potential bank failures may be limited, the possibility still exists. Bank failures can occur when an institution is unable to meet its obligations or when its liabilities exceed its assets. In such cases, the Federal Deposit Insurance Corporation, FDIC, steps in to protect depositors. But the impact on the local economy can be significant. When a bank fails, it can lead to a loss of jobs, reduced access to credit, and a general decline in economic activity in the affected community. For this reason, the stress currently being felt by these small and regional banks is a cause for concern, not just for the banks themselves, but for the broader economy as well. Given the crucial role that small and regional banks play in their communities, it's important that regulators and policymakers closely monitor the situation and provide support where necessary. This could include measures to help banks strengthen their balance sheets, such as providing access to capital or offering regulatory relief. Customers of these banks should remain vigilant and proactive in managing their own financial health. This might mean diversifying their banking relationships, exploring alternative sources of credit, or even considering larger, more stable financial institutions. if they have concerns about their current bank's stability. The stress currently facing hundreds of small and regional banks across the US is a significant issue that warrants attention. While these banks are not necessarily on the verge of collapse, the pressure they are under could still have serious consequences for the communities they serve. As economic conditions continue to evolve, it will be important for these banks to navigate the challenges posed by rising interest rates and exposure to commercial real estate carefully. At the same time, regulators, policymakers, and customers must remain engaged and proactive in addressing and managing the risks associated with this stress. The resilience of these banks will depend on their ability to adapt to the changing economic environment and to continue providing the essential services that their communities rely on. While the road ahead may be challenging, with careful management and support, these banks can weather the storm and continue to play a vital role in the U.S. economy. Brian Graham, co-founder of Claros Group, highlighted that instead of shutting down, struggling banks might scale back on important investments. This could mean fewer new branches being opened, limited technological upgrades, and reduced hiring of new staff. Over time, these choices can affect the quality of service that customers receive and limit the bank's ability to support local businesses and economies. For example, a bank that chooses not to invest in new branches may reduce its physical presence in certain areas, making it harder for customers to access services. Similarly, a lack of technological investment could mean slower or outdated online banking platforms, frustrating customers who rely on these tools for managing their finances. And when banks don't hire new staff, it could lead to longer wait times and less personalized service, which can be particularly frustrating in smaller communities where relationships with bank employees often play a key role in customer satisfaction. For individual customers, the direct impact of a small bank's financial difficulties might not be immediately noticeable, especially if their deposits are within the insured limits. Shayla Baer, former chair of the U.S. Federal Deposit Insurance Corporation, emphasized that as long as deposits are below the FDIC insurance limit, currently set at $250,000 per depositor, per insured bank, per ownership category, there is no need to worry about losing money. The FDIC is a government agency that protects depositors by insuring their deposits in case a bank fails. If a bank does go under, the FDIC guarantees that all insured depositors will be reimbursed up to $250,000, ensuring that most individuals don't lose their savings. This safety net provides significant peace of mind, especially for those who don't have large sums of money in the bank. However, while individual depositors may be protected, the indirect consequences of a bank's struggles can still affect them. If a bank is under financial pressure, it may cut back on loans to small businesses, making it harder for local entrepreneurs to secure funding. This could slow down business growth and job creation in the community, ultimately affecting the local economy and quality of life. Additionally, a stressed bank might increase fees or reduce interest rates on savings accounts to shore up its finances, which could cost customers more in the long run. These changes might seem small, but they can add up over time, impacting the financial well-being of individuals who rely on their local bank for affordable and accessible services. The FDIC plays a crucial role in maintaining public confidence in the banking system. By insuring deposits, the FDIC ensures that most people's money is safe even if their bank runs into trouble. This insurance coverage is particularly important for small banks, which may not have the same level of resources as larger institutions to weather financial storms. Knowing that depositors are insured up to $250,000 allows customers to continue banking with confidence even if their local bank is facing difficulties. This protection helps to prevent panic and bank runs, where large numbers of customers withdraw their money simultaneously out of fear that the bank will fail. Such runs can exacerbate financial problems and even lead to the very collapse customers are trying to avoid. For those who have deposits exceeding the FDIC insurance limit, it's wise to consider spreading their money across different banks or ownership categories to ensure full coverage. This way, they can be sure that all of their funds are protected no matter what happens. As small and regional banks across the U.S. navigate the current economic challenges, it's important for both the banks and their customers to remain vigilant. Banks must carefully manage their resources to avoid further strain, and customers should stay informed about their bank's financial health and consider the security of their deposits. While the impacts of financial stress on small banks may be more subtle than outright closures, they're nonetheless important. Communities may notice a decline in the quality of services, fewer new banking options, and a potential slowdown in local economic growth. For individuals, understanding the role of FDIC insurance and how to protect their deposits is key to ensuring financial security. By staying aware and proactive, both banks and their customers can work together to navigate these challenges and maintain the strong local economies that are vital to the fabric of American society.